Okay, let's unpack this. We have a fantastic, really dense stack of sources today that all center on, I think, one crucial objective:
Mm-hmm.
how to build durable long-term wealth. So if you're focused on sustainable investing, especially with an eye toward retirement security and that absolute goal of preserving your capital, this deep dive is for you.
Precisely. What's in front of us is, well, it's a remarkably comprehensive roadmap. It's a toolkit that's both timeless, I mean, it's rooted in decades of market history, and at the same time, it's hyper current.
Right.
It applies those old rules to today's lightning fast and very, very concentrated market. We're going to be examining the key metrics and the mental models favored by investors who succeed over decades, not just a few good days.
And our mission here is pretty crystal clear. We are diving deep into the key words that define stability and longevity. We're going to start with the non-negotiable stuff, the fundamental math of growth and preservation.
The rule of 72.
The rule of 72, exactly. And that cruel reality of what happens when you lose money.
Yeah.
Then we'll pivot to the more qualitative side of things, the economic moat. How do you find a business that's durable enough to not just fall apart?
And then finally, we'll apply all of these durable frameworks to the market's most influential and I think most debated area today, the Magnificent Seven. We'll look at their digital moats, the regulatory headwinds they're facing, which are serious, and the critical 2026 outlook.
Yeah.
The sources are clear. Achieving your financial goals reliably means you have to master two sort of mathematical engines: compounding, which is how wealth grows, and negative returns, which is how volatility can just permanently destroy it. You have to master the math first.
Right.
Because if you don't play by the rules of arithmetic, no stock selection strategy in the world is going to save you.
So let's start right there with the math shortcut every long-term investor really needs in their back pocket, the rule of 72. I love this concept because it immediately translates an abstract percentage into something tangible.
Into time.
Into time, yes. It visualizes the impact of your rate of return in a way that, nothing else really does.
It's truly indispensable for any kind of financial planning. The core concept, for anyone who's maybe not familiar, is just beautiful in its simplicity. You take the number 72 and you just divide it by the annual return rate you expect as a percentage.
And that's it.
That's it. The result is the estimated number of years it will take for that investment to double in value.
And the power here isn't just in the calculation itself, right? It's in the comparison. The sources really drive this home. The sheer magnitude of the difference that even small, consistent changes in your return can make over a lifetime.
Oh, it's huge.
So let's look at a very conservative profile. Let's say a high-quality bond fund or a secured annuity, something that gives you a modest, maybe guaranteed 4% return.
Okay, so if we apply the rule, 72 divided by 4, that equals 18. 18 years for your capital to double.
18 years. So if you're 35 and you're planning to retire at 65, that gives you one full doubling, and maybe you get part of a second one before you retire. It's slow.
It's very slow. Now, let's compare that 4% to something like the long-term historical average of the S&P 500,
Yep.
which has been closer to, 10% before you account for inflation.
Okay, so 72 divided by 10.
7.2 years.
7.2 years to double. I mean, just think about that difference for a second. You are doubling your money in less than half the time, 7.2 years versus 18. Just by choosing an asset class that, over the long haul, provides that superior performance.
And the exponential difference becomes almost unbelievable when you start stacking those doublings.
Yeah.
So that same 35-year-old, if they get that 10% return, they get roughly 4 doublings by the time they're 65. That's 30 years divided by 7.2 years.
4 doublings. So what does that look like in real money?
That 10% portfolio goes from, say, $100,000 to $1.6 million.
Yeah.
Whereas the 4% portfolio, it barely scrapes past $200,000. It fundamentally transforms the potential outcome of your entire life.
And just to put a fine point on the preservation side of this, what about a really low-yield vehicle, like a traditional savings account that might give you, 0.5%?
Mm-hmm.
You take 72 divided by 0.5, you get 144 years.
144 years.
144 years to double your money. It becomes so clear, so fast. Saving is for liquidity, for short-term needs. But investing and embracing that long-term calculated risk, that is the only mechanism for real wealth creation.
But that clarity, it raises a really critical question for anyone chasing that 10% average. What are the things that erode that rate of return?
A hidden cost.
The hidden costs. Because the rule of 72 is based on the net return, the number you actually see in your account, not the headline number the index achieves.
Exactly. The sources call this erosion the anti-snowball effect, which is a perfect name for it. And they use the rule of 72 in reverse to show the loss of your purchasing power.
And this anti-snowball works in, well, primarily two ways. The first and most obvious one is inflation. If you divide 72 by the inflation rate, that tells you how many years it'll take for your purchasing power to be cut in half.
Oh.
So if inflation is running at a target rate of, say, 2%, it takes 36 years for your money to lose half its value, which is, manageable over a lifetime.
But as we've all experienced recently, that can change really fast. If inflation is sitting at 3%, that halving time drops to 24 years.
And if we see high inflation, like the 8% rates we saw back in 2022, that time frame just collapses. It drops to only 9 years.
9 years to have your money be worth half as much. That is a permanent, non-recoverable loss of your capital's actual worth. The rule makes that invisible threat suddenly very visible.
It really does. And the second factor, which is maybe even more insidious, is fees and taxes.
Yeah, the ones hidden in the fine print.
Always. The sources give a great illustration. Imagine you earn a solid 10% gross return, but you're paying a seemingly small 2% annual fee. Maybe it's an actively managed fund's expense ratio or just high trading costs inside the fund.
That 2% fee, that brings your effective return down to 8%.
Right.
So what does that do to your timeline?
Well, it extends your doubling time from 7.2 years all the way out to 9 years.
Wow.
That seemingly tiny 2% drag just added nearly 2 full years to your doubling time. You lose a fifth of your time efficiency. Over a 40-year investment window, that can cost you hundreds of thousands of dollars in lost capital. It's huge.
This is exactly why there's such a focus on low-cost index funds or minimizing advisory fees. High fees don't just reduce your return a little bit. They fundamentally degrade the mathematical engine of compounding itself. They rob it of time.
And it's important to remember, as the sources know, the rule of 72 is an estimate. It's a mental shortcut.
Right, a guideline.
It's most accurate around an 8% return. For lower rates, like 2%, you might use 71 for a slightly more precise number. For very high returns, say 16%, you might use 74. But as a robust guideline, it's fantastic.
The takeaway, though, is so clear, especially when you connect compounding to an investor's time horizon. I mean, the sources show exactly why younger adults often gravitate toward higher risk, higher return investments.
They have time.
They have time for multiple doublings. They can ride out the short-term volatility, knowing that the exponential power of time is on their side.
But conversely, as you get closer to retirement, that whole strategy just flips on its head. The focus moves from maximizing returns to prioritizing capital preservation.
Absolutely.
Because one single large loss in those crucial years right before or right after you retire can derail decades of hard work. And that brings us directly to the other side of this mathematical coin, the real cost of a loss.
That transition is seamless. We have to talk about the mathematics of negative returns. This is why experts like Warren Buffett insist that capital preservation is rule number 1. His famous line, the first rule investing is never lose money. The second rule is always remember the first rule, isn't philosophy.
No, it's math.
It's just brutally simple math. It's the asymmetry of losses.
It's a concept that I think most novice investors fundamentally misunderstand. They get caught in this mental trap of linear thinking. They assume if they have a 5% loss, a 5% gain will get them back to where they started.
Right. Makes intuitive sense.
Yeah.
But it's wrong.
It's completely wrong because that gain is calculated on the new, smaller capital base.
So if you start with $100, a 5% loss takes you down to $95. A 5% gain on that $95 only gets you to $99.75. You are still down. You are still in the hole. And that deficit, no matter how small, now has to compound just to get you back to zero, let alone grow.
And that gap, that recovery gap, it widens exponentially the deeper the hole gets. Let's just look at the recovery math for a second. If you're down 10%, you need an 11.1% gain just to get back to zero.
Okay, manageable.
Manageable. If you're down 20%, you need a 25% gain. If you're down 33%, a third of your money is gone, you need a 50% gain to recover.
That's a huge hurdle.
It's a huge hurdle. The deeper the hole, the harder the climb, because you are calculating that percentage on a much smaller denominator.
And the most jarring example, the one that really sticks with you, is the 50% loss. If your $100,000 portfolio drops to $50,000, you need a 100% gain just to break even.
a 100% gain. Finding an investment that consistently provides 10% a year is already challenging. Finding one that can return 100% just to recover lost ground is exponentially harder, and it often forces you to take on even crazier risks just to get back to where you were.
This is why avoiding the big loss is mathematically superior to chasing the big gain. It takes, on average, 10 years for a portfolio to recover from a 50% loss, even if it's generating solid 10% returns after that loss.
You've lost a decade.
A decade of compounding power is just gone.
The sources move beyond these simple percentages to show the real-world impact of volatility on a portfolio, even when the average return is identical.
Yeah, this scenario was really eye-opening. They detailed two hypothetical portfolios, both with the same asset mix, 60% stocks, 40% bonds modeled over 20 years. And critically, both portfolios achieved the exact same average annual return, 10.6%.
But here's the kicker. One portfolio was 50% more volatile than the other.
Which means it had bigger swings.
Bigger swings, deeper drawdowns during market downturns, and the outcome, it was horrifyingly different. By the end of the 20 years, the less volatile portfolio had a balance over $600,000.
And the more volatile one.
It was nearly wiped out. It dropped to almost zero.
How is that even possible if the average return is the same?
Well, the sources identify two factors that compound on each other. First, the size and frequency of the losses were just magnified by the volatility. But second, those losses were coupled with necessary distributions. In the model, these represented withdrawals to cover, say, a retirement expense gap.
Ah, so you're selling when the market is down.
You're forced to sell when the market is at its lowest. This scenario perfectly illustrates something called sequence of returns risk, which is incredibly dangerous for anyone in or near retirement.
Right.
If a big 40% or 50% loss happens right when you start retirement and you have to sell assets to cover your living expenses, you are liquidating at the worst possible moment. You are permanently damaging the capital base that needs to last you for the next 20 or 30 years.
And even if you aren't retired and taking withdrawals, the sources make the point that any withdrawal, including just panicking and selling during a market drop, can cause that same permanent damage. The math dictates that preservation is actually the most powerful growth strategy you have.
The lesson is undeniable. High quality and low volatility aren't just, nice to haves. They are mathematical necessities, especially for an investor who's prioritizing longevity and security. The best time to minimize your losses is before they ever happen.
Which means focusing on high-quality assets. Assets that are structurally built to resist those deep downturns. That math is the perfect springboard for our next topic. We've established that the arithmetic of investing punishes losses way more than it rewards gains. So if the goal is to avoid those losses, we can't just rely on luck or market timing. We need a rigorous, replicable way to filter stocks. So how do we move from the quantitative rules of compounding to finding, qualitative reliability?
The tool is the economic moat. This is Warren Buffett's favorite metaphor, and it's endured for a reason. It represents a sustainable competitive advantage that shields a company's profits from attack. It protects the terrific economic castle, as he calls it.
So the moat is the defense mechanism.
It's the structural defense against the market forces that naturally try to erode profitability over time.
We're looking for a moat that's wide and, critically, one that's long-lasting. It has to surround and protect a valuable business, the castle, and preferably be managed by a capable and honest team.
And the sources really detail how this framework marks a huge philosophical evolution for Buffett, which was heavily influenced by Charlie Munger.
Right, from his early days with Benjamin Graham.
Exactly. Graham advocated the cigar butt philosophy. Buying statistically cheap, often mediocre companies and hoping for one last puff of profit before they go out of business.
That strategy works, but it's high effort. You have to constantly be turning over your portfolio. And as Buffett's own portfolio grew into the billions, it just became unsustainable.
So the shift came to the Munger philosophy. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
I love that quote.
It marked a definitive shift, prioritizing enduring quality and long-term durability over just being statistically cheap. The focus moved from what a company is worth today to what its earning power will be 20 years from now.
And that durability factor is so key. A moat isn't enough if it only lasts a couple of years. So analysts will rigorously assess the expected longevity. Will this advantage last 5, 10, 20 years?
They also look at something called key person risk. Does the entire moat depend on the current CEO or founder? If the advantage disappears when that leader leaves, it's not a structural moat, it's a leadership advantage, and that's much more fragile.
So what actually constitutes a moat? Investment research firms like Morningstar, whose work is cited in our sources, they categorize these advantages into 5 primary types. It gives investors a really practical way to assess a company's resilience.
Yeah, let's walk through those 5, because understanding the mechanism of the moat is vital if you want to identify a truly durable investment.
Okay, what's the first one?
The first category is intangible assets. This covers things like patents, unique software, government licenses, or just the sheer power of a globally recognized brand.
And the classic example here is Coca-Cola, which Buffett has talked about for decades. I mean, despite fierce competition in the beverage industry, their brand recognition, that emotional connection people have, and their vast, entrenched distribution network, it all creates these formidable barriers.
You can't replicate that overnight.
No competitor can just appear and erase Coke's market share. That brand moat is what allowed Buffett's initial $1 billion stake to compound into just staggering returns.
And it's not just soda. Think about pharmaceutical patents, which give a temporary monopoly on a drug, or the specialized engineering standards that some software firms hold. That gives them an irreplaceable advantage in niche markets.
Okay, so that's intangible assets. What's next?
Next is cost advantage. This means the company is structurally the low-cost producer, and that gives them 2 critical benefits. They can either undercut competitors on price to gain market share, or they can maintain higher margins than their rivals, leading to better profitability.
This is all about scale.
Scale advantage in action. Retailers like Walmart and Amazon are perfect examples. Their hyper-efficient supply chains, their massive purchasing power, it allows them to demand lower prices from suppliers and reduce their own overhead.
It's a virtuous cycle. Right?
Absolutely. Size lowers costs, which attracts more customers, which increases size, which lowers costs even more. It makes it almost impossible for a new company to come in and compete on price.
Okay, number 3.
Third are switching costs. This is the barrier created by the trouble, the expense, or just the friction a customer faces when they try to move from your product to a competitor's.
So the competitor's product can't just be cheaper.
No, it has to be cheaper than the rival's price, plus the entire accumulated cost of switching over. This is huge in enterprise software. Think about a big corporation running on SAP or Oracle. Switching means migrating decades of data, retraining thousands of employees, risking catastrophic downtime.
The risk alone is a huge deterrent.
It creates a massive moat. The sources cited a company called Nordson, which makes industrial dispensing equipment. Once that equipment is integrated into a manufacturing line, the cost of ripping it out and replacing it is just immense. It locks the customer in.
Okay, the 4th moat.
The 4th is the network effect. And this is maybe the most durable moat of all, because the product becomes inherently and exponentially more valuable as more people use it.
Social media platforms are the classic example. The first person on Facebook gets 0 value. Yeah. The billionth user gets massive value. A competitor can't just launch a better platform. They have to somehow convince billions of people to move their entire social graph over, which is deeply inconvenient.
And we see this with payment systems too, like Visa and MasterCard. The more merchants that accept the card, the more users want the card, which forces more merchants to accept it. Once these effects hit a critical mass, they are nearly impossible to break.
Okay, and the last one.
Finally, we have efficient scale. This happens when a market is only big enough to support one or maybe a small handful of competitors. The cost of entry for a new player is so high that it just deters competition. A new entrant knows that if they spend billions to enter, the entire industry's profits will just collapse for everyone.
So things like pipelines.
Oil and gas pipelines are the traditional example. Building a pipeline network requires massive upfront investment and regulatory approval. It naturally creates a monopoly or a duopoly because the economics just don't support 5 competing pipelines running along the same route.
So we've covered the qualitative side, the philosophy of finding a great company. But as investors, we can't rely only on metaphors. We need hard quantitative indicators to confirm a durable moat exists.
Right. If a company truly has a wide moat, it should show up in the numbers. It should be reflected in its ability to generate excess profits for a long, long time.
And the number one quantitative indicator for that durability, according to the sources and pretty much every serious long-term investor, is return on invested capital, or ROIC.
Absolutely. Let's spend a moment on ROIC because it is so much better than simpler metrics like return on equity.
Why is that?
ROIC measures how effectively a company uses all the capital it has, both its debt and its equity, to generate after-tax profits. Consistently generating a high ROIC, say above 15% for 5 or 10 years, is the strongest possible sign of a sustainable competitive advantage.
Because if it was easy to replicate.
If rivals could easily replicate the business, competition would drive that ROIC right down. A persistently high ROIC proves the moat is working.
Okay, beyond ROIC, financial health is obviously crucial. We need to make sure the castle isn't running out of money.
Yeah, you look for strong and consistent free cash flow generation.
And free cash flow is.
It's the actual cash a company generates after it pays for all its operations and capital expenditures. It's the real money left over to pay dividends, buy back stock, or reinvest in strengthening its moat without having to go out and borrow money. Companies with strong moats are often just cash-generating machines.
And that ties into low debt levels.
Exactly. A good moat allows a company to self-fund its own growth, so they don't need to take on heavy debt. And that makes them much more resilient during an economic downturn.
High margins are also a key sign, right? They reflect pricing power, which comes from a brand moat, or cost efficiencies, which come from a cost advantage moat.
This is precisely why firms like Morningstar developed their systematic moat ratings. Their analysts classify companies into 3 buckets. A wide moat means they expect the company to keep its advantages for over 20 years.
Okay.
A narrow moat implies durability for 10 to 20 years. And a no moat rating means any advantages are expected to, dissipate pretty quickly under competitive pressure. It's an attempt to quantify Buffett's qualitative judgment.
And the sources pointed out that the best long-term results come from finding that wide moat and an undervalued stock price.
You need both.
They gave a few examples of companies that recently got that coveted wide moat rating.
Yeah, we saw firms like Synopsys, whose AI toolkit gives them a unique technological advantage. Nordson, which we mentioned because of its incredibly high switching costs, and Sony Group, which has successfully shifted toward an asset-light recurring revenue model in gaming and entertainment. Analysts see that as much more resilient than its old hardware business.
It's not a guarantee of success, though. Sources provided a really interesting comparison between the S&P 500 ETF, SPY, and the VanEck Morningstar Wide Moat ETF, which is UAT. And the Moat ETF specifically targets these undervalued wide moat companies.
And the comparison showed that while MO8 has tracked and even slightly outperformed SPY since it launched, it doesn't, vanquish the passive benchmark,
Right.
which highlights a crucial point. Quality is essential, but buying a wonderful company at a terrible price is still a bad investment. Valuation always matters, even when the moat is wide. Moat investing is a tool for preservation and consistency, not a silver bullet for guaranteed outperformance.
So we've established these durable rules. Compound relentlessly, avoid losses, and protect your capital by investing in companies with strong moats. But how does this all apply to the current investment landscape, which is volatile, to say the least?
The whole climate has fundamentally changed. The physical slope for that compounding snowball has given way to the digital one. If Buffett built his fortune on physical staples like Coca-Cola, insurance, industrial giants, the modern focus has shifted entirely to the digital staples.
And that structural change brings us directly to the most concentrated, most influential, and probably most scrutinized area of the market today. The Magnificent Seven, or M7.
The M7 alphabet: Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. They are the new essential utility providers. They are effectively the infrastructure layer for the entire global economy now.
The dominant stats are just staggering, and this is where that concentration risk really comes into sharp focus. As of the end of 2025, their collective market cap was around $21.68 trillion.
And even more critically, that one group alone now accounts for roughly 1/3, 34.4%, as of January 2026, of the S&P 500's total value.
Wow, a third.
That concentration has just exploded. It's up from only 12.3% back in 2015.
Their moats are built on 21st century advantages, right? Technological innovation, massive financial strength, scale, and data.
And data. They have global reach, incredible brand recognition, and a proven ability to adapt because they spend so much on R&D. They spend billions every single quarter just to develop new competitive advantage.
And the competition among the M7 is just hyper-dynamic, especially as this AI race accelerates. And the beginning of 2026 brought a pretty significant tectonic shift within this elite group.
That's the story of Alphabet's re-rating. Google's parent company officially surpassed Apple in January 2026. It hit a valuation of $3.89 trillion and reclaimed the title of the world's most valuable public company for the first time since 2019.
And this wasn't just incremental growth. It was a total reevaluation of their whole business model.
It was. The sources credit this shift to Alphabet successfully transitioning from being seen as just a legacy search engine, a business that was maybe prone to disruption, to becoming a vertically integrated AI-first utility.
They managed to weave AI into almost every single product they have.
And they leveraged several distinct moats all at once to do it. They have their own proprietary silicon, their tensor processing units, or TPUs, which gives them a cost and performance lead in AI processing. Crucially, they have vast data moats, which is the foundational fuel for training these large language models.
And their Google Cloud division is the delivery mechanism.
Exactly. Their cloud backlog hit a record $155 billion in early 2026. That represents a massive pipeline of future, high-margin, recurring revenue. It confirms their enterprise moat is getting wider.
It's fascinating how the whole market narrative just flipped. Alphabet surged in 2025 after it proved that AI wasn't a threat to its core business. AI actually strengthened it. The AI-powered results improved user engagement, optimized their ad pricing, and it boosted their margins.
But this hype around the M7 as a group, it kind of obscures the reality of their recent performance, which has been really uneven, and that speaks directly to this concentration risk. Despite the Magnificent Seven having an average return of 27.5% in 2025, which is a great year, only 2 of the 7 companies actually outperformed the broader S&P 500's 17.5% return.
And those 2 winners were Alphabet, with its phenomenal 65.8% return, and NVIDIA, with 40.9%.
Right, both fueled by AI. The other 5 M7 stocks actually lagged the index, which highlights that even within this elite club, performance is becoming highly dependent on who is winning the current technological race.
And this unevenness, combined with the top-heavy structure of the index, that's the massive concentration risk. The S&P 500 is just extremely reliant on this very narrow group.
We saw the downside of this in 2022. When the tech sector corrected, the M7 stocks as a group fell 41.3%. The broader S&P 500 only declined 19.4%.
Wow.
The sources are clear. A concentrated earnings base magnifies downside risk. It can wipe out years of compounding for investors who are too overweight in these names.
And there's another critical factor that separates this modern digital moat era from the industrial era. And that's the intense regulatory scrutiny the M7 face all over the world. This is a powerful non-market challenge to their dominance. We could call it the anti-moat.
That's a very accurate term. These digital giants are under constant pressure over antitrust, data privacy, global trade policies. It's a completely different world from the industrial companies Buffett traditionally favored. Governments are actively trying to weaken these moats.
And the sources highlight that 2026 is the year of the remedy phase,
Yeah.
following that landmark United States v. Google antitrust ruling. Specifically, the courts prohibited Alphabet from paying for exclusive default status on browsers and mobile phones.
Which was a critical part of their distribution moat. And what's interesting is that while this was initially feared as a revenue killer, the ruling had a counterintuitive benefit.
It actually improved their margins.
It improved their margins. By stopping those exclusivity payments, Alphabet saved the billions it used to pay out annually to partners like Apple and Samsung. It freed up massive amounts of capital, and the market absolutely loved it.
But the threat is still there, and it's expanding globally. Management teams across the M7 are flagging these risks in their SEC filings.
They are. The sources specifically mention the EU AI Act and ongoing litigation, particularly in ad tech in Europe, as these persistent threats that could force major structural changes or even divestitures by 2027.
And what does the EU AI Act do?
Well, it aims to regulate high-risk AI systems, demanding high standards for data quality, transparency, human oversight. While it's meant to promote safety, it creates huge compliance costs, and it restricts how companies can leverage their vast data moats, which is a core competitive advantage.
And management is also flagging the massive capital expenditures, the CapEx required for this AI race.
Oh, it's enormous. Companies like Meta are estimated to spend around $64 to $72 billion in CapEx just this year alone. That tests the efficiency of the whole ecosystem, and it can really strain profits if the returns on that investment aren't immediate.
So we've got a handful of companies carrying the market, fueled by an AI narrative, but facing these severe regulatory and CapEx burdens. The moats are huge, but the anti-moat pressure is just as big.
So moving into the overall market outlook for 2026, the sources point out this significant conflict that every investor has to reconcile right now. You've got exuberant analyst optimism running headlong into the cold, hard reality of elevated valuations.
The optimism is truly striking. The Wall Street consensus for S&P 500 earnings growth for 2026 is projected at about 15%. I mean, to put that in perspective, the long-term average is 8 or 9%.
Right. So if that holds true, analysts think the broad index could rise somewhere between 8% and 17% this year.
But that strong earnings assumption is driven almost entirely by the Magnificent Seven and the tech and communication sectors they dominate.
And the sources note a deep underlying problem there. Since 2018, there has been very little, if any, fundamental earnings growth from the bottom 493 companies in the S&P 500. The entire market growth story rests on 7 pillars.
And this optimism comes against a pretty severe backdrop of high valuations. The current P/E ratio for the S&P 500 is trading at about 22 times forward earnings.
Which is high.
Historically, that level implies the market expects perfect outcomes. It's well above both the 5- and 10-year averages.
And on top of that, corporate profit margins are exceptionally high, which is a key risk indicator. The estimated net profit margin for the S&P 500 is around 13.9%. That is near its historical high since 2008.
And high margins raise immediate questions about sustainability. That brings us to the 3 biggest risks to sustained growth in 2026 that an investor focused on preservation really needs to understand.
Risk number 1 is simple: analyst bias. Analysts, especially in their early forecasts, are historically biased toward optimism. It's an institutional incentive. These bullish estimates are very likely to be revised lower as the year goes on and actual results come in. You just cannot take that 15% growth forecast at face value.
Okay, risk number 2.
Unsustainable margins. Since corporate profit margins are already near historical highs, some compression is highly likely as the economy normalizes. As competitive forces intensify, companies will find it harder to pass costs on to consumers, and margin compression has historically been a huge dampener on earnings growth.
And the third risk, which we've already hammered home, is concentration risk.
Right. If the Magnificent Seven, who are carrying all the weight, underperform, whether from regulatory setbacks, competitive threats, geopolitical issues, the impact on the overall index will be disproportionately huge. The bottom 493 companies just don't have the growth to offset a major downturn in big tech.
So any divergence from that perfect script increases the risk of lower valuations and significant volatility. So given this environment, high valuations, high optimism, and these structural challenges, the sources provide a critical checklist for the informed investor. A guide focused squarely on quality and preservation over just chasing momentum. This is how you protect that capital snowball.
This is all actionable advice derived directly from analyzing these systemic risks.
Okay, first on the checklist, expect earnings revisions.
Since we know analysts start too optimistic, investors should monitor quarterly guidance and track any downward revisions. Those are your early warning signs. Downward revisions often precede broader market corrections, so it gives you a head start to adjust your risk.
So pay attention to the forward guidance, not just the reported earnings.
Exactly.
Second on the list, focus on quality over momentum.
In a high valuation environment, you have to prioritize companies with strong balance sheets, consistent free cash flow, that quantitative sign of moat-stable profit margins, and resilient business models. When growth slows, these higher quality companies tend to outperform or at least decline less, while speculative names get crushed.
So look for businesses that can weather a recession, not just capitalize on a boom.
Precisely.
Third, manage valuation risk.
With P/E ratios this high, you have to be mindful of what you're paying. Avoid chasing prices that imply perfection. A useful tool here is the PEG ratio, the price to earnings divided by the expected growth rate.
Okay, how does that work?
If a company is trading at 25 times earnings but is expected to grow at 50% a year, its PEG of 0.5 is attractive. But if it's trading at 25 times earnings and only growing at 10%, its PEG of 2.5 suggests the price is way too high for the growth you're getting. Use metrics like that to see if the price is justified.
Fourth, monitor economic indicators.
Right. Keep a close eye on the macro data. GDP growth, inflation, the labor market. These directly influence corporate profits and margins. Early signs of a slowing economy should prompt you to reevaluate your equity risk, maybe shift toward more defensive sectors like utilities or healthcare.
Fifth, diversify beyond the U.S. market.
The U.S. market is so concentrated in those few tech names. Diversifying internationally can reduce that concentration risk. You might find stronger valuations and more attractive earnings prospects if the U.S. market slows down because of pressure on the M7.
And finally, number 6, Use defensive instruments appropriately.
In times of uncertainty and high valuation risk, adding ballast is paramount. This means high-quality government bonds, low-volatility equities, or even simple hedging strategies. These assets provide stability and help mitigate that downside risk when earnings or the economy disappoint. It reinforces that fundamental rule: preserve your capital. This has been a true deep dive into the principles that prioritize longevity and security. We've covered the mathematical power of compounding with the rule of 72, and we've seen the absolute necessity of avoiding large losses because the math of recovery is just so asymmetrical.
We also tracked the evolution of finding business durability. We saw the search shift from physical moats like Coca-Cola's brand to the modern digital moats of the Magnificent Seven, and we identify the unique risks that come with today's market concentration and regulatory scrutiny.
And the theme woven through all of this really is discipline and structure. Successful long-term investing isn't about finding the next hot stock or chasing yesterday's returns. It's about adhering to a framework, using the math to set realistic expectations, and identifying durable quality, the moat, to avoid catastrophic errors.
The focus has to be on what's replicable, what's reliable, and what's transparent.
Which raises an important final question for you, the listener.
Yeah.
What approach is best for your goals? We've focused a lot on Warren Buffett's framework. He's the ultimate fundamental investor, spends 80% of his day just reading and analyzing moats and financials. His methodology is transparent, it's fundamental, and it's replicable by any investor willing to do the work.
But the sources also provide this fascinating sharp contrast. Jim Simons, the mathematician turned quant whose medallion fund generated an astounding 66% annualized return before fees for 30 years. Simons' firm uses purely automated technical trading models. They completely avoid fundamentals. They don't care about moats or CEOs. They just care about mathematical patterns.
And his purely technical approach generated the highest returns in modern history. It eclipses Buffett's track record, which is just incredible proof that these alternative, purely mathematical strategies exist.
However, and here's a provocative insight for you to think about. Simons' medallion fund is completely closed to outside investors, and his public-facing funds, which have to follow regulatory rules and capacity constraints, they often lag the S&P 500.
Which strongly reinforces that for the average investor, for you seeking a reliable and practical path to protecting and growing your capital, a transparent, fundamental framework like Buffett's focus on moats and quality strategies you can replicate and understand remains the most practical path forward.
The best returns in history might be inaccessible, but the most proven, durable strategy for longevity that is wide open to you.